Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
We kind of hung out for a while after we made the gap. And then we kind of, from that period at around 56 there, we actually had a big reversal and a pullback all the way down to around 54 before the trend resumed and continued to the new highs. So here's the difference between the novice gap and a professional gap. Okay? What happens is a professional will gap prices higher, and the reason they gap prices higher is so that they can trap all the longs who think the trend is going to continue. And once they trap everybody, what they try to do then is that they try to drop their bids below so that everybody who bought the top is trapped. So that's why we call it a professional gap. It's pretty hard to see on a weekly chart, but we'll look at it on a daily chart. It's a little bit easier to spot. So in November we said, okay, the British pound, the dollar is strengthening here. We want to stay with the trade. But I also said I don't want to sell any kind of upside potential. I would probably rather use a put at the bottom of that range just to protect myself, because for some reason it was just moving straight up and it really wasn't suggesting any kind of exhaustion at that point. And sure enough, about 3 days after I did these slides, we did break out to the upside and we made another extension higher. So now the 65 area would probably become support. Well, we actually broke out of the 65-69 range later and made another gap. And this time you can see the candle after the gapping candle actually is what we call a bearish engulfing candle near the top of the chart. So it's a little easier to see here on this chart, and it's another one of those professional gaps. So I put a little line here that says old resistance should become new support at 69. Obviously, anytime you break out to the upside, you should find some support where the origin of the breakout happened. But not all the time, so be careful. My review of the weekly chart on January 29th says we hit the 52-week high during January at 73.81. The week following the new high, a correction brought the dollar back down to the point of the breakout near 69. But notice, this is normally a good point to initiate a new long position. However, the later it is in the trend, the more likely it becomes that you're going to find aggressive sellers, and that kind of support will get broken pretty easily. So when we look at our charts now, we were able to push through the 69 support level and actually started to push back down closer to 67 or so. As soon as this happens and this weekly candle closes below that prior support level at about 71.35 or so, we got to watch out for that to become resistance on the way back up. Okay? And again, a couple of weeks later, we're still trying to test this top in the middle of February. I'm drawing my trend line again because we're still making higher lows, but at this point we're trying to test this upper resistance level. So now we're kind of like stuck. And a few weeks later, it's still the same thing. We're still staying above our trend line, but we can't get through this resistance area. And now we're at 228. So this was a couple of days ago. So if we break it down to a daily chart, there is our gap again. We have our gap to where we get up to the top here, and all of a sudden we base for a few days, and then we collapse out of the bottom. And that's usually what we call a professional gap. The professional prices will gap up like that and then base for a while, and then the big institutions will drop their bid below this 71 area and pretty much trap everybody that's above there. And once they do that, of course, prices will drop pretty rapidly as everybody tries to get out and cut their losses. So the later in a trend this happens, the more likely that's going to happen. So we see a professional gap on 120. The novice trader is invited to buy the top once they see the gap higher in price, believing that the trend is going to continue. And the professional traps the novice by lowering his bid after the gap, which traps all the traders who bought the top and forces them to sell. So this area between 71 and 73 is going to be a resistance area for quite a while now. Our Canadian, moving quickly here. Our Canadian, of course, is one of these currencies that has gone flat for long periods of time in this uptrend. So our original little trading range here that we were planning for, we were just trying to collect premium for the 9 months or so that we were inside the range between 103.50 and about 97. And that lasted for almost 9 months. But on June 24th, I said, watch out for a breakout and buy some calls on the breakout above there. Well, once we did break out of this trading range, it wasn't a very big breakout. And this is something we talked about the first time I did this presentation. If you're a breakout trader and you bought 104 and you're sitting up at 107 and you've got a profit, take some off if you come back, because there's always a chance you could have something called a retest. So the breakout wasn't very strong, and a couple of weeks later we were retesting. But usually what happens with a trader is they're part of that breakout candle, they don't take a profit, and they panic out when you get back to where the breakout happened, right at the point that you should have bought in the first place. After a few weeks, we actually based at a higher level here, which again, this currency has had a habit lately of just going sideways for long periods of time, the dollar versus the Canadian. And then in September, we actually said, watch out again on these retracements. You want to be able to lock in some profits if you didn't have a hedge on it at that time, because you have the opportunity for something called a pullback to support entry. So we could take a breakout if we went above this 108 area. So we were looking for a new breakout entry above 107.65, as well as another test of the support. So at this point, while we were still inside this channel, it was possible we could find a breakout above here or actually retest for a possible double bottom here. What happened was we really got going in a hurry. Fundamentally, the Canadian economy had really big problems, as well as our economy. But of course, since they're so tied to commodities like gold and oil, and since both of those were being absolutely destroyed by all the hedge fund redemptions that were going on, our dollar really shot up against this one too, and we went from 108 to 130 in almost a heartbeat. But we did hit 130, and we broke down pretty good and kind of almost retraced all the way back to 115 at this point. So this one was kind of like out of a rocket ship, and then just kind of topped out really fast. So in November, we said we're trading in a very large range again between 114.65 and 130. When the high end of the range was reached, the dollar index, remember those dollar index charts I was looking at, we were testing weekly resistance at 87. To hedge the position with volatility being high, you could do some kind of a covered right. So now, because this Canadian index, really you can't see the resistance on the left side of the chart by just looking at the Canadian from ISE, it's also a good idea to keep an eye on something that's got a little bit more history to kind of use towards planning your predictions for your trades. So that's another reason I like to watch that dollar index. So I say, okay, so use the resistance from the dollar index in November to determine when and how to hedge the currency pair that we're trading that not have as much history as that does. So here you'll notice when I come to 129, we're still inside this channel. One of those rare triple tops, which you don't see too often here. We tested 130 resistance now 3 times and failed. We actually came down and extended the bottom of the range from 114 to where we actually started finding support at 119. So this is kind of important because this indicates again that the sellers are not that aggressive. They can't push prices down as low as 115 like they were able to in the past. Now every time they push it down, buyers are willing to pay 119. So that kind of gives you a clue that you might be breaking out to the upside in this particular chart pattern rather than having indecision. So again, I'm looking at this on 210 just a few days later, and we're still inside the same triangle, but notice how it's starting to narrow. It's winding up like it's a rubber band, like it wants to pop here.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.